and hello, Shri.
Hello, hello. We have Shri on today. I still can't I believe that we brought him on our podcast. What an honor.
To those of you who can't see and only listen to the audio, I must describe the smile on Yoav's face. It's like a teenager meeting, I don't know, Justin Bieber or something.
True, true.
How are you, Shri?
Fantastic. Gilad and Yoav, thank you for inviting me. Thank you for asking me to be on your podcast. Yoav, I've known you for a number of years.
Yeah.
We met in Zurich the first time at John MIHALJEVIC's event. Thanks to John for conducting a great event and generally putting a very thoughtful group of people together in his community. I'm still a member. I still love getting his weekly emails. But I've gotten to know you through that. I just love the country, Israel. There's a long history of highly accomplished people from Israel. Couple of wonderful books on Israel that I have started reading. Israel, the Startup Nation. But anyway, it's great to be on your podcast. Thanks for inviting me today and looking forward to this conversation.
Maybe we start by you telling us your correct pronunciation of your full name, so we at least have it once correctly. I don't want to try to say it.
Yeah. My full first and last name is Srikanth Viswanathan. The thing about Indian names, almost all Indian names, is you pronounce every letter. And of course, it's a long first and last name. I have 22 characters between the two. And when I came here as a student many years ago, without
Here
dating,
is in Chicago.
Yes, in Chicago, one of my professors had great difficulty pronouncing the name. And as soon as he started struggling, I knew it was my name. So I put up my hand and he said, how should I call you? I was just brand new to the country. I was always known by Srikanth. And since I was struggling, he said, how about I call you Chuck? And he wrote CHUCK in big letters on the board, and everybody started calling me Chuck for that class. But anyway, I just go by Shri for my American friends.
Thank you for the help. It's easier with Shri. Okay, let's start with some general disclaimers and sponsorships so we can get on to our fabulous content that we're going to talk to you about investing. So we're going to do it in Hebrew. חברים, זה לא ייעוץ השקעות, זה לא שיווק השקעות. כל מה שאנחנו רואים פה זה רק למטרת הרחבת ידע ולימוד. כל פעולה שמישהו רוצה לעשות שקשורה בהשקעות ובניירות ערך צריכה להתחשב בנסיבות האישיות של כל אחד ואחד, ואי אפשר לעשות את זה בפודקאסט. מוזמנים לפנות באופן ישיר ולקבל את הייעוץ האישי. לי או ליואב וגם לשרי יכול להיות שיש עניין במניות שנדבר עליהן, גם את זה צריך לקחת בחשבון. אז שימו את הכל בפרופורציה, זה רק למטרת ידע ולימוד. ושימו לב שיש לנו נותני חסות בקישורים למטה, גם אינטראקטיב ישראל, גם פספורט קארד, ואתם מוזמנים להצטרף גם לניוזלטר שלנו ולקבל פעם בחודש את התכנים שעניינו אותנו באותו חודש, ויש גם לינק ליצור קשר עם יואב. מוזמנים לבדוק את הכל למטה, ובואו נפנה את הזמן המדהים. לשרי, יואב, שאלת הפתיחה אליך, בתור מי שהבאנו את הרבי שלו.
No, as you said, I'm really, for me, I say a lot of guests have been special, but this one is special. As Shri said, we met in Switzerland, and I don't know, for some reason we found a reason for a conversation. I actually remember the conversation. Shri, if you remember, maybe we'll start off with a small question before the investment quote. If you remember, I pitched MFAIRFAX Financial. And
Yes.
And just before we got on today, I was reading his latest annual letter, PREM WATSA, I don't want to
Yes.
get right into the issue, but I remember then you were a bit skeptical about Prem and his way, and for the first couple of years, it was good that I listened to you, but after that, I think it was good that I kind of chose my own. I decided to be a real value investor and go against the grain. But you have any thoughts about Fairfax, Prem, WATSA? Do you still follow the company, by the way?
Absolutely. Absolutely. I think, he is an astounding operator, insurance company operator, more fantastic human being.
Yeah.
He's also more global compared to, say, Berkshire Hathaway and a few other insurance companies that you can think of. But just a fabulous human being, a very smart investor, and a fantastic insurance operator. I did read the most recent 39-page letter that came out. I thought he covered a lot of ground.
We'll put
I
it in the
liked
show notes
a
or
few
something.
things in particular. We can go into that later. But I remember that conversation that you and I had.
That we talked about it was
Yeah,
way
I'm so
cheaper.
excited that you forgot the quotes. Let's do the
Yes,
quotes.
no, I
Let's
said,
don't
yeah, let's do
forget
quotes.
it.
Sorry,
Start with the quotes.
I told you I'm
My
excited.
bad.
I'm not.
Me too. But
Go
let's
ahead,
do
go
it.
ahead.
No, give us the first quote, Yoav. It's yours.
My first quote, yeah, sure. So I took it from the letter. That's why I connected. Prem WhatsApp from the latest letter, and we'll put in the show notes quotes Phil Carre or Carret. Shri, how do you say his name? I think.
Well, correct. Yeah.
Carre, yeah. So he said, and I think it's a great quote for an episode with you, is that good management is rare at best. It is difficult to appraise, and it is understandably the single most important factor in security analysis. Short translation, Phil Carre, who was a famous investor, even Warren Buffett, I think, called him out in one of the meetings that he was from Fidelity, if I'm one of the funds. So, or Pioneer, I'm not remember, one of the funds. Anyway, so מה שהוא אומר שהנהלה טובה זה משהו שמאוד קשה למצוא, ומאוד קשה להעריך הנהלה טובה של חברה, אבל זה עדיין כנראה הגורם החשוב ביותר שאתה עושה ניתוח של חברה. And back to English, and I don't think we could find anybody better to help us understand how to analyze a good management team than Shri. But go ahead, your quotes first, and Shri, you want to go ahead and say something about this one, and yours, go ahead, if you have a quote.
Sure. I have a quote. Let me start there, and then we can jump into Phil's comment. The one that I really like is Warren Buffett's quote on the single most important factor in evaluating a business. So he said, single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a great business. And he goes on to say, on the other hand, if you have to conduct a prayer meeting to even raise prices by 2%, then you've got a terrible business. That has become a lot more important factor in my evaluation over time. But back to Phil's comment, evaluating a management team, I think that's a very qualitative feature, qualitative factor, and it's not necessarily a one-time event. Management teams change, they have turnover within the company, and even if it is the same person running the company over a long stretch, evaluating that person over a period of time and in different settings would sort of give you a good picture about the quality of that management team. And that quality is important because, you and I, we are on the outside, minority investors. We are always going to know less than what the insiders know, and you want them to be managing, to be good stewards of our capital over a long stretch of time. And so, there are all those different types of issues that come into play when thinking about the quality of the management team. When I say good stewards, it's not just a matter of quantitatively being good stewards of capital. We want them to be, very motivated to run a committed organization. We want them to have good relationship with their employees, with the suppliers, with the entire ecosystem. And we can go into examples if you want later on. But the quality of the management team is both quantitative and qualitative. That's why that comment by Phil is so appropriate. I actually tweeted it a few days ago when I finished reading that letter. But
I didn't see that yet, so I didn't. So I didn't copy you. That copied PREM. That copied Phil. So no, it's good to.
I tweeted it from his letter saying this is a great letter.
I didn't see that for some reason. Even okay, great. Good follow on Twitter. I recommend your Twitter and also your friend. If we have time to talk about Chris Mayer, the guy from the 100 Baggers book is a good follow as well on Twitter.
Absolutely.
Thanks, Gilad. We don't want to, of course, skip your quote. Best for last. Yes, go ahead.
I have a quote, and I don't remember who said it, but I listened to Shri quote it in another podcast that you participated a year ago that I re-listened to prepare myself to this episode. But I think it's funny and it's very, very accurate. It says that I have never went to bed with an ugly woman, but I sure have waken up with some ugly woman in the morning. And I think that it's not just funny, it's extremely important, especially in the investment world, because once you're in love and intoxicated, everything looks good. But only after you spend some time with in a relationship or with a company or with a person, you really understand what was the little lies that you tell yourself while you're being in love. And the true key to successful relationship and investments, I think it's both, is to see through all the lies that we tell ourselves when we are in love, and to see that the person is truly good person that we want to communicate it, or the investment is truly good and not only sexy. Let's say it's like this. So
yeah, it was actually a quote that Buffett used to describe acquisitive companies. And he was quoting a country singer, and that was the context in which he had quoted it. Now, those were the years when Buffett used to write in a very colorful manner. Those were fantastic letters.
Yeah, age has also caught up with him a bit, I guess. Gilad, where can we start? Where would you like to take this?
I would like to ask you, I mean, first, looking at your work, and we talked about it in our episode, so if you want to know a little bit more about Shri's work, so I recommend stop listening now, go back to the episode that we did on him, understand, and then come back. But I would
even better, read his letters, which we'll put in the show
read
notes.
His letters, which are an amazing read. But I think that what I admire most about your work is the in-depth work to analyze a company and to know it very, very deeply and thoroughly, and to choose and to decide which one of them is a quality company. And in your last letter, you said something really, really amazing, that sometimes you need to say goodbye to the good in order to make room for the great. I don't remember if this exact quote, but the general idea.
Yes.
Because you hold, I think, only 10 companies in your portfolio, which is very, very brave, I feel. So I would like to ask you a general question, but I think the most important question. What is a quality company? What is a quality business? When you are looking for the great, that you're willing to not hold the good, what is it? How would you describe it?
Right, that's a fantastic question. In fact, I have a 4-part question to my investment objective. And this is my second question that I ask. Is it a good quality business? And I end up spending, even though I have 4 questions in that investment objective, I end up spending most of my time on this question, and perhaps just about the same amount or slightly less on the next question, which is about the management team. But to answer your question, what is a high quality business? Or more importantly, why is that important? We can come at this from a variety of different angles, but I would say for me, the definition of quality of a quality company is both quantitative and qualitative. Quantitatively, I'm looking to partner up with a business that is generating a healthy return. What is a healthy return? Again, it goes back to my objective. My objective is to double the capital over a business cycle. A business cycle is about 5 to 7 years. And if I wanted to do it in 5 years, it translates into a required return of approximately 15%. You got that rule of 72. And so it translates into approximately 15%. So if that's at the portfolio level, then at the individual company level, be it 10 stocks, 10 businesses, or 15 or 20, whatever the case may be, that may be your portfolio. You want to adjust it accordingly. For me, I give myself room to go from somewhere between 8 to 12 businesses in the portfolio. And in each business, I'm trying to generate a return that in aggregate at a portfolio level can lead me to this 15+%. So individual stocks, I want them to be generating much better than 15 because they all have a different cycle pattern. And so while one stock may be undergoing a challenging environment, the other one could be enjoying a better market environment. So I take all that into account and I expect a return that is generally better than 15 at the company level. But let's dig further. And what do I mean by return of more than 15%? What kind of return am I expecting? The value of a business is essentially the present value of the future cash flows. It's all cash flow of the business that matters to eventual valuation of a business, right? We use a number of different shortcut back of the envelope computations like price to earnings or price to cash flow or enterprise value to EBITDA, all kinds of multiples. But these are all just shortcuts to arrive at what we think is appropriately, maybe approximately close to the cash flow metric that we all want. So I sort of set that aside and I just look at the cash flow. At that point, I'm looking more at the historical cash flow. I'm not even looking at the forward next 5 years, 12 months, 5 years, 10 years. I'm not doing that. I'm just looking at the historical. Now it was, I think Winston Churchill who said, the farther back you look, the farther forward you will be able to see. So I want the companies to have been in a good position, to have been generating a healthy return. And most of the businesses that I'm interested in, or businesses that have been public for a while, there is one in the portfolio that's 188 years old. Unfortunately, not all of them are that old. but I can go back 10 years. In a few, I can go back 20. And in one, I can go back as far as I want. But I want to be able to see them over different environments. We've had the tech boom and the bust in early 2000s, the financial crisis in the 2007, 2009 time period, COVID, of course, more recently. I want to be able to see how these companies performed, not only just how they perform. I also kind of go back and read the transcript, read the annual reports, and see what they said about those periods before it happened, while it happened, and after it happened. That kind of gives me some color, some context about the management team as well. But I want to see the historical performance. And what am I looking for in those historical performances? I'm looking for cash return on capital. Since it's the cash flow that is the most important piece, I'm looking for cash return on capital. So
ROIC?
Yeah, there are a couple of different ways of looking at this. Let's go with the denominator first, capital. Capital, you can look at it from both sides of the balance sheet. Most databases will go with equity and debt, and some will adjust for cash. But essentially, the right side of the balance sheet, equity plus debt is the capital, and that's what most databases will do. It's easier to capture that way. But the more interesting one would be to look at the asset side of the balance sheet. You can then see how efficient capital is being utilized. So I do both because most databases provide the right side. I use that as well. But I kind of then spend time try to understand the constituents of the balance sheet. I adjust out for a few extraneous things, maybe redundant things, excess cash, things like that. Arrive at capital. Both numbers are generally the same.
Goodwill. How do you treat goodwill? If people don't understand, Shri is also an accountant by trade. So if anybody has a question, then ask us after the chapter. That's fine. But yeah, if you could answer about goodwill, Shri, that would be great.
Yeah, so that's an important question. It depends on what type of a business model it is. Gilad started off by quoting Buffett, who was referring to acquisitive companies. These acquisitive companies typically will have some kind of a goodwill on the balance sheet. So in those situations, I typically like to hold the management team accountable for the decisions that they have made, which is acquisitions. And through acquisitions is how these goodwill numbers crop up. So I want to hold them accountable. So I look at it with goodwill. But then you also want to know what the operating performance of the company is without goodwill. So you X out goodwill. So I look at it both ways. And it depends
basically,
on
just clarification about this, if I can, because I think it's very interesting. So you say that even though the goodwill, it's not really a tangible asset, because this is a price that the acquirers were willing to pay, so you want to see the return on what they pay. So you put it inside, but you want to do also how the business is working, regardless to the price that paid for it, like from the total assets that are invested in it. So you are looking on both with and without goodwill. I understand correctly?
Exactly. As I said, you want to understand how the management team has deployed capital, how efficiently they are managing capital, how they have thought through the business model. And so if they have constantly acquired businesses, I do have a company called HEICO, which is an acquisitive company, sort of a serial acquirer, if you want to call it that. So they've generally used cash. They take a little bit of debt, but they've generally used cash and debt to pay for these acquisitions. But they are decisions made by the management team to grow the business. So you want to understand how they have thought this through, how those acquisitions have played out over time. And so that's why I want to include goodwill. But in certain situations, you want to sort of exclude that goodwill because you want to see what the business is without those acquisitions, or what's organic growth. Typically, the company will say what the organic growth is, but the operating performance without goodwill, you want to see how that has performed. So it's better to include both or look at it both ways. So that's the right side of the balance, the left side of the balance sheet. And so that's the denominator. In the numerator, it is cash flow, of course, but if we're interested in free cash flow, after meeting all the expenses, capital expenditure. And there I also make another adjustment. That's another self-imposed adjustment. The classic definition of free cash flow is operating cash adjusted for CapEx, adjusted for dividends. Well, I have businesses that pay a dividend and others that do not pay a dividend. And that's a deliberate decision taken by the management team and the board. So to make everything equal, to make all companies sort of at the same comparison level, I do not deduct dividend payments from my computation of free cash. So maybe it is a slight benefit for the guys that are paying a dividend in this computation, but in any case, I want to keep the comparison across the board the same, and so I don't adjust for the dividend payment. So free cash is the numerator.
Free cash after CapEx, but before dividends, right?
Correct. So, I want to see what the performance is, what the cash flow over capital is in any 1 year. And then since I'm looking back over 10, 20-year period, I want to see what the variability of that performance has been over time. So you can compute the coefficient of variation of that metric over a long stretch of time. It's essentially the standard deviation over the mean. I know I'm getting a little technical, but that coefficient of variation kind of tells you how volatile that metric has been. You can use this coefficient of variation on any metric you want. But generally speaking, I want the variability to be on the lower end of the spectrum, and something around, it's a ratio without a metric, and so something around 30, as opposed to something with a 3-digit number. Something around 30 would be more closer to where the volatility would be lower. And so, I kind of look at the performance of cash flow over the stretch of time and use this coefficient of variation. I look at the ratio of cash flow, free cash over the capital. And then I also
but just to make sure I understand correctly, it's two different kinds of return on assets. Return on assets and the return on capital on the capital, right? It's two different.
Well, it's not quite return on asset. It is still the return on capital. I'm just computing capital instead of from the liability and the equity side of the balance sheet. I'm also computing capital on the asset side of the balance sheet.
But allow me to ask, because I'm not an accountant and I'm not the best understanding of accountant, but from what I understand, The balance must always be balanced. So the left side and the right side should be the same. So what's the difference?
Yeah, it is not a whole lot different. It's very close most of the time. It depends on things like, as Yoav asked, if I'm using goodwill or not, if there is excess cash that I want to take out from the capital ratio, from the capital base, things like that. You want to spend time understanding the business model, spend time looking at the balance.
For each business, you will choose different things according to the business.
Of course, capital is not. Yeah, the definition of capital is the same for all businesses, but the composition of capital will be different from one business to the other. It could be, in fact.
I think this is a very important note to take here, because what you are saying is you are using the accountant as a language to understand the essence of the business. You're not taking it on the surface level. You're using it, you're implementing it according to the inner meaning of the business and the needs of it, and the meaning of the numbers in the balance sheet. Not just as numbers, as what they're representing in the real world, in the real business.
Absolutely. Yeah, you put it very nicely, Gilad. Thank you. Yeah, it is. It takes a little bit of, if you're trying to do this for, hundreds of companies, yeah, you want to have.
Maybe you can just tell us the essence that you want. What you're trying to extract out of the balance sheet. You're trying to extract all the assets that the business is using in order to generate the cash flow?
Exactly.
Okay.
Exactly.
So you're extracting from the balance sheet the true assets and capital that is using to generate the cash flow, and you're trying to, and you are calculating the return of the cash flow minus capex before dividends on the actual assets that generate those. And what you're saying is, guys, listen, don't use the numbers in the books and as they are, because they're not a true representation of the assets of the company. So here, an implementation of what you're saying, and I don't want to deter you from the answer, because I think we're in a beautiful process, but the meaning is that all the quant investors, you got some problems there, because you're just using the numbers without understanding the essence of the business. So you're going to have some mistakes.
Well, I don't know if I would put it that way. I will let you do that. But all I'm saying is, there can be redundancies on the balance sheet in terms of certain types of assets, certain types of liabilities too. I mean, one of the important reasons why I also compute capital from the asset side is it then gives you a way to think about the efficient use of capital. It's not just slapping debt and equity to come up with capital. That's the easier way to compute. So quantitatively speaking, you can run hundreds of companies using the same methodology. But certain businesses may have certain nuances where you want to be able to give them credit for certain redundancies, take them out, and then look at what the business truly generates on the required amount of capital, not the redundant base of capital, on the required amount of
the redundant. Okay, very interesting. And then you're looking for a high return and a consistent return with not very variation. You don't want a business that 1 year is doing 100 and the next year is doing -10.
Yes, again, all these the metrics that I'm throwing out, they're just guideposts, right? So, for example, I have started investing in India recently. As you probably know, the country is growing at a very rapid clip, and as a result, individual companies are growing at incredible pace. And so this coefficient of variation that I'm describing is way north of 30, because every year they're putting up growth at 30, 40, 50%. In a mature business, for example, Hermes, which is that 188-year-old company, which is also growing at a double digit. In a mature business like that, I can expect to have a coefficient of variation that's more closer to that 30 that I was describing. In a rapidly growing, very robust, well-capitalized, owner-operated kind of a business model, sometimes it is appropriate to have a coefficient of variation that's way north of 30. But again, you want to be able to understand the business model, the dynamics of the ecosystem in which they are operating, and then give them credit or not give them credit. That's the nice thing about the analysis that I run. It's very case specific. I don't do the same thing for every company. It's the same process, but every company's setup is different. And so the ecosystem in which they operate could be fairly mature. And for example, I own Copart, which is a Texas-based salvage yard company, largest salvage yard company in the country. And it's a very mature business, but still growing at a healthy double digit. But I don't want to use the same expectations on, say, one of the Indian companies. Company may be mature, maybe sort of a company that was set up 50, 60, 100 years ago. But given the current market dynamics, it's growing at, multiples of where Copart is growing at. So I want to be able to, take individual companies and evaluate them on their merit.
Right. Chief, thanks for that. I have a question that just crosses my mind when you say all this. When you find these superb companies, and this is a question I think that's relevant for all investors, and I'm sure you have a pool of these. Just one question. The math is like this. If one of these companies puts up double-digit returns on your ratio, which was what you're looking for, and if it continues at this rate for 10, 20, 30 years, a compounder-type company, you can buy it at almost at any price. Not any price, but you can buy a nice price for it, like Heiko, which is definitely not cheap today, which you say you still hold.
Or Hermes.
Or Hermes also. And so how much of valuation is that probably what makes your decision to buy or sell? Or because you can always justify a high price for these compounders. How do you think about that in your process? And we have something to, yeah.
And I think I would join the question of Yoav, because it's exactly what I wanted to ask here. I mean, usually those companies, you're not the only one that will know that they're good companies. Everybody will know, and it will be reflected in the price. So what's your position about paying high prices? When I think about Hermes, it's an amazing business, amazing, but when I look at it, it looks risky to me to pay so much, such a high multiplier for a company that if there will be a great recession in the world, I don't know how it will survive it, and I'm scared paying high prices, or Costco or other companies that are good and priced accordingly. How do you do it?
And I'd add to Gilad, is there a difference between buying and selling? Just tell you in one sentence, Gilad and I did a short study where we found it's again over Buffett's career. Sorry, I want to let you answer, Sri, but just tell you, I think it might interest you. We checked Buffett's 10 biggest stocks that he bought over his career, and we checked the returns if he would have bought and held them for the Coca-Cola, Moody's, and those for the whole his whole holding period. And what would have happened if he would bought and sell them when they got expensive using a P ratio, like he was doing with Apple. And we found that buying and holding these great companies, even when they got expensive, other than with two companies, his better strategy would have been to buying and letting and not selling them each time after you take taxes into consideration. So enough of us. The floor is yours, of course. That's with our background.
Yeah. A number of questions. Between the two of you.
Take your time.
Yeah, I mean, I remember only a couple of them. I'll come back and ask you to repeat the question later on. But I think, Gilad, your question about why pay such a heavy multiple on some of these companies, Hermes or Heiko or whatever. And I'll take a step back and first of all, if you ask the question as to why some of those businesses are trading at such a high multiple, you may think LVMH is a good peer, good comparison for Hermes or Kering or one of the luxury apparel companies. Maybe. I wouldn't necessarily put any of those in the same bucket as Hermes. But if you compared the two groups, yeah, Hermes valuation would be very different compared to the rest. And so if you ask as to why Hermes is trading at that multiple, one reason, and this is just based on my research and my conversations with people who have been doing this for a number of decades and who've been very successful at it. One thing that came out was it's the predictability of the cash flow. It's the predictability of the cash flow that makes people to, appreciate the predictability. And as a result, the valuations move up relative to its own history and relative to its peer group. I mentioned that's one of the reasons, that's one of the paths by which I ended up with this metric of coefficient of variability. And if you look at many of these companies that you think are trading at a high multiple, and you run this math, okay, cash flow over a stretch of time, and the coefficient of variability over the 10-year, 20-year, 30-year period, you will invariably come up with this range of somewhere around 30 or even less. And put that against some of the newer companies, not just the tech companies that have gone public, but newer companies in other sectors. And you will invariably arrive at coefficient of variability. Many of the times they will not be making free cash. And if they did, that number would be meaningfully higher. And so that predictability is what I think it comes down to. And that's the reason why the multiples are high. Another sort of a side note, and this question came up in one of the events that Terry Smith held. Terry Smith is the founder of Fundsmith in London. I've learned a lot through his, reading his letters and reading his blog posts and things like that in the past. But in one of the annual letters, he actually ran this exercise. So he said, we own L'Oreal. I don't own L'Oreal. I used to. I don't own. He still owns L'Oreal. So this was a few years ago. He said, I own L'Oreal, and it's a company that's trading at, I don't know, at that time it was trading at a healthy multiple. Things have come in, particularly as a result of Estee Lauder's troubles. But he ran this exercise and he said, I can go, generally speaking, the return out of any stock is approximately something like 7 or 8%. I don't remember the exact single-digit number that he pulled out. He said that's the expected return over a long stretch of time. And if it's 8%, I can go all the way back and into early 70s. I could have bought L'Oreal at as high as 270 times earnings, and still generated this 8% return. And he ran through the exercise of different decades and different number of chunks of years. The point is, it's not that he wants to pay 270 times earnings. He's just backing into it. It's like a reverse DCF kind of an exercise, that he's backing into what multiple he could have paid to generate a certain return out of that stock. And I think that's a very valuable exercise to think about when you think about these types of high multiples. That's on the quantitative side. On the qualitative side, which is where I think most of these businesses win hands down. And if you take Hermes, for example, 188 years old, 6th generation family member. The family itself owns 67% of the stock, no debt on the balance sheet. And more recently, there have been articles about even Walmart and Amazon coming out with replicas of Birkin or even Kelly on their in their stores and their websites, but it's truly not a Kelly or a Birkin, right? When Kelly Birkins, they go for at least 15,000 plus. Truly not, no competitor in sight at this point. Chanel is probably one that's somewhat close enough, but at least on the women's bag side of Hermes, there is truly not a competitor. And if there is one constant in business, it is the reversion to mean. A business that's generating, say, 20% return on capital, because of that number, it'll attract a lot of competition, and as a result, the returns will revert back to the mean. Mean is typically the cost of capital, right? Cost of capital is 7-8%. That's probably how Terry Smith arrived at that number. But in a few businesses, they are able to defer this reversion to mean or postpone it for a long period of time. If you ask as to why and how they are able to do it, it comes back to this competitive edge, right? If you can, in the US in football, in college football, there is an award called Heisman for the best college football player. And the statue of a Heisman is a guy who is kind of putting out his left hand out. And so we say, if there is a business that can give a Heisman to its competitor, generally those are the businesses that are able to claim this competitive edge for a long period of time. So I can go, name by name. Hermes, as I said, has been around for a long time. Even LVMH, which is a competitor in a few areas, is truly not competing with Hermes on its women's bags and a few other categories. Copart, the closest competitor, has been acquired. It is now under a different company, Ritchie Brothers, and it's a stronger competitor now, but still a much smaller competitor. Between the two of them, they have more than 85% market share in the salvage business. HEICO, they manufacture aircraft parts, 19,000 parts, 500 new parts a year. Again, management team owning, 8.5% of the company, little, less level of debt compared to its competitors. Again, fabulous business. These are the types of businesses that sort of fit my mold. Again, investing is a very personal exercise, right? We all want to skin the cat in different ways that feel comfortable to us.
But what you're basically saying, let me see if I understand. You're saying when the business is good enough from the perspective of his moat and the ability to win competition, then the prices are justified, to simplify your answer. I have a follow-up question from a different angle. So basically, what you're saying is that I believe that this business will be able to continue to generate great return on his assets and grow them. And secondly, other investors will be willing to pay those multiplies, those big multiplies, and even more in the future. So eventually my investment will grow. Am I correct?
I agree with the first one. I'm not sure about the second one.
Okay.
Yes, eventually.
Because this is a risk. Because one of the things that I think about those great businesses, yes, I agree. It's very difficult and maybe impossible to compete with them. I don't believe there is someone who can compete with Costco in the world. But it doesn't really matter the specific example. I agree that it's very difficult and maybe impossible to compete with them. But in order for my investment to be a successful one and I will make money, I'll need that all the other investors in the environment would be willing to at least maintain those multipliers. And we know that maybe it varies. People are optimists and are sometimes pessimists.
Gilad, I think I'll help you with the question. I think your example of Costco maybe it's a good one, or sure, one of your companies would. But let's put a number on it. Would you buy a great company like Costco or HEICO?
Or Hermes, let's talk about
Hermes at a 60 times multiple to the free cash flow that you use? Would you buy at such a price, or if you hold it, would you sell at such a price? You don't talk about your specific holdings. That's why I don't use Hermes. But go ahead use the number 60 because that's the multiple. I know Costco today, for example, and let's run with that if you can.
Right, and instead of necessarily engaging with you on the 60. I'll engage with you with the biggest fan of Costco, Charlie Munger, late Mr. Charlie Munger. What did he say about in terms of thinking about valuations? One very critical comment he made was, if you are able to buy a business, say a business that's generating at cost of capital, 6-7%, whatever the case may be, and even at a discount, right? 3-4 times earnings, or even 2 times earnings, whatever the case may be, as say Buffett used to do back in the early days, the cigar butt kind of a situation. And if you hold it for a long enough period of time, your outcome is likely to be the rate at which the business generates its return. He didn't stop there. On the other hand, if you are able to buy a company that is generating, say, 20-25% return on capital, whatever the case may be, something much higher, meaningfully higher, and even if you paid what may look like a high multiple, again, if you held it for a long enough period of time, your returns are likely to be the returns of the business. That is an astounding observation by late Charlie Munger, right? And
so basically, if I understand correctly, you're saying that for the long period,
for a long period of
The
time.
changes in the multiple will be not very meaningful because of the return on assets and the cash that will be generated. So
Exactly. That's exactly what Charlie Munger is suggesting, is saying over a long stretch of time, what matters is the quality of the business. That brings it back to my investing style. We didn't get into that early on, but that brings it back to my investing style and perhaps your listeners' investing style as well. That's why I said investing is an individual is an individual sport. We can skin this cat in many different ways. There are fabulous traders who trade very actively on a regular basis. And there are other investors who take a fairly long-term approach to investing. I'm in the latter category. I take a fairly long-term approach. We are in the middle of March, or almost end of March. I'm meant to make a change to my portfolio this year. I did make some changes middle of last year, and I literally have not made any change to the portfolio in a few months. So I kind of take the slow approach to investing. And that's why focusing on the quality of the company, quality of the management team, and focusing on, holding investments for a long stretch of time.
But when you do make a change, I want to go back to the valuation, because our job is to find these great companies on a day-to-day basis, and I'm sure you've come across one or two this year. So when you make the comparison to an existing holding, would you first look at the quality to assess whether you'd make a change, or would you put valuation, or how does that process go across? When you're so concentrated, it must be a tough decision to make for you.
Yeah, absolutely. In fact, this may be a good time to kind of run through my investment objective. And it goes in the same order, irrespective of where the company is located or which country I'm interested in or I'm working on at that point. It's 4 questions. Is it a business that I can understand? Right by that definition, I'm telling you that there are businesses that I don't understand. I was an investment banker. I was doing M&A in the East Coast and the West Coast of the United States. Spent a lot of time in many sectors, but I never spent any time on oil and gas or mining, or more recently in Bitcoin and the crypto world. I'm not a trained healthcare guy, and so I don't have any expertise in biotech. And so I kind of stay away from those things. But fortunately, I've spent time in financials, in industrials, in tech, in consumer, a number of different areas that fall within my area of interest and expertise. So that's question 1. And question 2 is what we started with, the quality of a business, which is where I spend most of my time. And then question 3 is also something we sort of talked about early on in this podcast, which is the quality of the management team. I want them to have skin in the game. I want them to be aligned with various constituents. Skin in the game, treating the employees well, aligned with the shareholders in terms of management's incentives and compensation structure. I am aligned with my investors, meaning almost all my wealth is in the fund. And similarly, I expect the management teams to have skin in the game and be aligned with me, the outside investor. And so I spend a lot of time on the proxy, trying to understand how the management teams are compensated for their annual performance, long-term performance, and things like that. And then finally is where I get to, is it a reasonable valuation? And again, when I ask that question, I am not necessarily saying a reasonable valuation is 10 times earnings, 15 times earnings. That's not what I'm saying. I am, again, looking at the individual businesses, the competitive strength, quality of the management team, ownership, and everything, the return generation. Hermes, for example, the gross margin of Hermes is more like a software company at 70+%. Net margin is very healthy, 40-some%. And that's not the case with a retail business. I own a company in Poland called Dino Polska. Healthy business, but it's not 40%. So each business is evaluated slightly differently from a valuation standpoint. And I want to be able to pay a reasonable valuation and not necessarily a hard and fast rule about a specific number. So that's how I come at.
A technical question, I think I know the answer, but just to make sure. So basically, when you evaluate a business, and as you said, first or second, you go to the quality of the business and calculate the return on the assets and everything. So it's a manual process. I mean, you don't have any software, you don't use any tools. You just go you take up all their reports, read them, extract the numbers, put them in a formula, calculate it yourself year by year, do the variation. It's like an art. Like Hermes is doing a bag, you're evaluating a company in a way.
Very nicely put, Gilad. Yes. That's how it has to be, right? I own only 10 businesses. I have the luxury of owning only 10. But that also allows me to get to know the businesses more intimately. And I'm able to understand certain nuances. In fact, on a daily basis, apart from having conversations like this, about 80% of my time I spend on existing portfolio companies, the 10 and its peer group, to understand the 10, as opposed to looking for new ideas. I'm always looking for new ideas, but most of my time is on the existing portfolio. Something or the other is happening. As I said, India is a new country for me. There's so much to learn about the country, about the various businesses. So there is something or the other for me to learn on a daily basis. And so, it's a luxury. It's also something that I like. That's how I want to live my life in a manner that satisfies me, and not just because how the system is designed to work. I have been on that side. I used to be at a couple of different very storied franchises here in Chicago, typical classic asset management businesses. We owned anywhere from 55 to 120 names in portfolios. And so I've been on that side, and that was one of the skeletons that I saw in the closet that I did not want to have when I launched my fund. So you put it nicely, Gilad.
I want to ask you about the Indian market. One of the most very interesting things that you wrote about it in your last letter is the starting investing in the Indian market. And it very intrigues me. And I think it's really interesting also for our listeners. So what can you tell us generally about the Indian market, about what you saw there, about who you chose to buy there and why? I think it's a very interesting topic.
Yeah. I'm originally from South India. It used to be called as Madras. It's now called as Chennai. I came here as a student a number of years ago and have stayed back. What what I left, the country that I left is a distant shadow of what it is today. It used to be a socialist democracy. Things have changed rapidly, particularly since I'd say early 90s. What they locally call as the Big Bang. India got to a point where it had only 2 weeks worth of FX reserves in its treasury, and so the administration at that time had to open up the economy. It was a wake-up call, and the economy has been on an upward trend since then. And more recently, one of the drivers has been the demographic profile. Lots of people have written about this. It's now the most populous country in the world, 1.5 billion people. About 50% of them are less than 26, 27 years old. It's a very young population, a lot of testosterone and estrogen, and it has to be managed appropriately. And without necessarily getting into the politics of it, after some struggles, even after the 90s, this administration that has been in place for about 10 years has come up with more business-friendly policies. There are still a lot of cultural and political issues, religious issues that sort of hamper the growth. But in spite of all that, I think the country has continued to grow at a rapid clip. It's one of the largest, maybe the only largest country in the world today, growing north of 6%. Even China has sort of trimmed its growth back down to 5 and something around 5. But it's growing at 6+% at the GDP level, but starting from a very low base. What I have observed over the last few years is how the business environment has evolved. More, when I left the country, people of my age at that time left the country because of limited opportunities for certain types of, caste-based people and things like that. That has changed. More people have, more families have sent their kids to the US, UK, Australia to get educated, and they've all gone back. Many of them have taken some of the Western lessons back to India, perhaps. And overall, things have opened up quite meaningfully. And particularly, if you read my letter, particularly over the last 10 years, India has done some fabulous developments when it comes to technology. In the US, for example, we have these social security cards, essentially IDs, personal IDs. We don't use it on a regular basis for many things. But India came up with a system, very similar system, where it captures the iris and the thumbtack, and it's called Aadhaar card. Every individual needs to have a card to do pretty much anything on a daily basis, to open up a bank account, to open up a brokerage account, or whatever the case may be. You need this Aadhaar card. And think of 1.4 billion plus people. getting these highly technical data captured. So that was one. The second piece was, the administration wanted to have the ability to distribute financial support, particularly to the downtrodden, to the lower end of the spectrum, economically speaking, people. And there was a lot of leakage in the past. It would go through middlemen, and by the time the money actually reached the actual recipient, it would be at if $100 were sent, the recipient would get something like, a lot lower, $10, $20 instead of the actual 100.
Wow.
And so there was a lot of leakage in the process. The administration came out with a procedure where all Indians, particularly the lower end of the spectrum, end up having a bank account. So the administration can press a button and essentially within seconds can deliver cash into their account, or some sort of a financial support. And that came in handy during COVID. But that was another major accomplishment. And then finally, this is the best accomplishment, I would say, which is they came up with a payment processing ecosystem. It's the most digital payment processing system country in the world today. So, for example, if you end up in any city, any town in India today, and even if you went to a street vendor selling, say, fruits, mangoes are big in India, particularly during summer. What's that?
Samosas.
Samosas,
yeah.
In the past, particularly when I left the country, you will have to walk around with a pocket full of cash or change, and that's what you would pay the vendor for buying stuff. Today, you don't need to carry any cash. All you need is your phone, your GPay, Google Pay, essentially connected to your bank account. There was a QR code in the vendor's station. You flash your phone and bam, the transaction is completed. And it's not only fast and efficient, it's also tax efficient. What used to be a cash transaction was outside the tax regime most of the time. Today, the recipient, the vendor who gets the cash, the money is actually going into his bank account, which falls under the tax web. And so the tax collection rate has continued to go up. And so all these factors have sort of come to a very nice confluence. And the country, as a result, is seeing some phenomenal growth. Yooav, you said you read PREM's letter on FAIRFAX. There is a section in there where he talks about FAIRFAX India,
the Bangalore airport. Yeah.
The Bangalore airport. But he has a couple of tables in there about the economic and social achievements over the last at least 10 years. GDP has grown to 3.5 trillion from 1.9 just about 10 years ago.
US dollar?
Yeah, dollar.
How much is it per capita?
Yeah, per capita, it is still relatively low. It's 2,500. US is about 85. China is about 17 or 18,000. So it's still a relatively low base. But that 2,500 was just about 1,500 10 years ago. And this 2,500 per capita is actually even lower than the GDP per capita of Sri Lanka. So it's relatively low.
So there's a big run rate ahead?
Yes, yes. And that's the point. So those are all at the macro picture, and individual companies within the country. There are some fabulous businesses that have been around for a long time. A few of them have become public only recently. And so, those are the reasons why I find India to be attractive. But at the same time, I would say until recently, valuations in India were even, if you thought some of the valuations on the companies that we discussed were high, valuations in some of the Indian companies were beyond nosebleed.
Wow.
Over the last 4 or 5 months,
it's come down a bit.
The market has, the market has come down. Valuations have come in, and things have become a lot more interesting.
But just to mention a technical problem with India, I'm sure you went through this process, but most investors outside of India cannot actually participate and buy equities there. You have to go through a long process and then to be able to do so. Even you as a citizen have to go, or you grew up there, you have to go through this process, I understand.
Yeah, I'm an American citizen, and that's the reason why I had to go through this process. If you're an Indian citizen, Indian passport holder, you don't have to go through that process.
Okay.
But I went through a process which was about a year long, just a truckload and a half full of documents. And it was an onerous process. But you at the end of the day, you have to still come back and realize that it's an emerging market. It has many inefficiencies. This is one of them. They have their own reasons sometimes. Sometimes it's just a matter of legacy policies that have not been eliminated. So the red tape is high, is heavy, and that, at least that's how I'm giving them the benefit of doubt. It is frustrating.
We have some of that stuff here back home. I'm actually the only one in this conversation. So if you want, Gilad, if we have some time, maybe sure if you want to talk freely about your experience or what you've read about Israel, your experiences here, investing or otherwise. You haven't been yet. We have extended invitation. It's an open one for you to come, of course. But if you want to talk, feel free about your relationship to Israel and so forth.
Yeah, it's as a religion, it's one of the oldest, just as old or even older than Hinduism. There's a long history of trade between the two peoples. There are actually temples in India.
I've been to one of them, yeah.
On the West Coast.
Yes.
Mumbai, and in Kerala. And when I grew up, there was one in Chennai too, in Madras. Not sure if it's still around. But I've always been a fan of the innovative, the technology-heavy focus of the country, innovative approach to, surviving in a tough environment, and the businesses that have been founded. And I know Google just did this big acquisition recently, but I myself have looked at a number of businesses in Israel. One I was invested in for a little while, and then for filing reasons and other opportunities outside, I exited. But my experience, I certainly want to visit. I was this close to visiting Israel on one of my trips out to Dubai, but somehow the schedule didn't work out, and so I couldn't make it. But I certainly will, and you all, I certainly will let you know, and you're going to be my guide, local guide.
Of course.
Okay, let's close some business here, Yoav. We are planning to do a convention in the summer. Why don't you come and talk in the convention?
Let's go back to. I thought you were going to take us back to investing. We'll leave that off there. Sure, we'll let you. We'll
Sure.
keep it an open invitation. Talk to us. I know both of us are very
Really very
keen
happy
on
to.
the insurance
Oh, yes.
business. And that's what I think I've learned so much from you about. You want to tell us maybe about your experiences, why you think um, so much opportunities there, and maybe about I know Kinsale is a company you've talked highly of in the
Right.
past, and you might want to say a few words about them, what they exemplify in your process.
Right. Yeah, that's how we started. We met for the first time and we started engaging. Yeah, my background is also in insurance. Before I went back to University of Chicago for my MBA, I was working for an insurance company in Des Moines, Iowa. Great combination. You probably sitting out in Israel may not know the boring combination of insurance and Midwest of the United States, but that's where I was, even though the insurance company I work for is more on the life side. They do what is called as 401k, the deferred contribution pension product. And I had some exposure to insurance from that angle. But once I got to know the investment side of the business, particularly through Buffett and many of his followers, I realized this very powerful angle that insurance companies can exploit. I'm sure you've heard of the Davis family. Chris Davis is now on the board of Berkshire. Chris's grandfather, there've been a couple of books written about him. One I think was his autobiography,
Davis Dynasty.
Davis Dynasty, Davis Double, and he was an insurance regulator that kind of saw this, was at the starting point of when this art of deploying capital into the equity market, into the investment world, was beginning. So many different lessons from people like that. And I told you I spent time at Advisory Research here in Chicago, a very storied franchise where I was essentially the one who was doing all financials because nobody else wanted to do it. I had some background in insurance and banks. So I ended up spending a lot of time with these insurance companies, fabulous management teams, companies like N-Star Group, which is being acquired, White Mountains, which is still around. Old Fireman's Fund is White Mountains Group. Many high.
They sponsor our podcast. Their passport card, which they own, is one of our sponsors. Yeah,
White Mountains is one of your sponsors.
No, I'm kidding. I'm kidding. But they're
White Mountains own Israeli insurance company in the field of travelers insurance. It's a very good company, and they sponsor our show.
Fantastic. You're in great company then.
Yeah, definitely.
Yeah, I mean, Berkshire, of course, Fairfax, up in Canada, out in Cincinnati, there is another company called American Financial Group. So, I've spent time looking at these different types of insurance companies and how they have managed both the underwriting side of things. Most insurance company management teams are focused on the underwriting appropriately, but they kind of outsource the investing side of things to outside managers most of the time. 95% of the portfolio would be invested in fixed income securities. And if you read, the Davis Dynasty, in one of the books, he says right up until the mid-50s, it was actually frowned upon or prohibited for insurance companies to invest in equities. So almost 100% was invested in fixed income, and maybe a couple of other asset classes like real estate and a few things. But things have evolved. But in spite of the evolution, even today, we see most insurance companies maintain a very hefty allocation to fixed income.
In Israel as well. In
Israel too, yeah. That's an easier, I mean, there is both a logical reason as well as the ease of investing, ease of operations. Logical reason is because obviously the liabilities have to be met appropriately whenever the claims come through. And so in the US, for example, we have 50 different state regulators. And so the regulators require, in fact, there are 2 sets of books for insurance companies. That's very unique to America. You know, US GAAP, generally accepted accounting principles, is the primary SEC mandated accounting policy. But for insurance companies, which have been around for forever in the US, they are more, the insurance regulators are more interested in the going concern of the insurance company itself, meaning they want the claims to be met by the insurance companies. And so their focus is more on the balance sheet. And so they follow an accounting policy called statutory accounting principle, SAP. And there the focus is on the balance sheet. GAAP, US GAAP, is more the focus on the income statement, matching the income and expense. So there are a couple of different major differences between the two, but essentially they're all trying to capture the 2 sides of the financial arena. And the regulator wants to make sure that the claims are met. And so the liabilities have to be in somewhat easily accessible investments. And that's why fixed income is an easy option for them. And because it's fixed income, the underwriters, the management teams and the boards, they can take their eye off of that part of the business and focus exclusively on underwriting, which is important. But as you have noticed, Yoav, over time, what has happened in this business, in this sector, is particularly post this 1950s period when equities were allowed, and even within fixed income, the market has matured, particularly during very healthy market periods, healthy equity market periods or healthy fixed income market periods, and sometimes both are relatively healthy. Management teams take their eye off of underwriting too. And that's when they end up writing business at a loss, combined ratio of more than 100, thinking they'll make up for the loss on the investment side of things. That has come back to burn many management teams. Again, when you spend time, and this is a business where you can go back, in time to do the exercise that I described earlier on. There are enough businesses with 10, 20, 30-year track record. You can see how they have performed over different periods, how they have actually, if you go back in time, you can read about how management teams tell you publicly that they are writing business at 100 or close to 100 because they're making money on the investment side of things. So, that kind of gives you a picture about how the management team is viewing this. Let me take a step back. Insurance is one of the few businesses where you do not know the cost of goods sold at the point of sale. So this is a business where getting to know the management team becomes even more important. how they think through the different environments. Many of them, almost all of them, realize that it's a cyclical business. The cycle extends, sometimes as much as 17, 18, 20 years. But most of the time it's shorter than that. But it's a cycle. Many of them will realize it, know this. But you want to understand how the management teams have thought through, particularly the soft market where, the companies are not able to jack up the premium, as opposed to the hard market where they are able to take the premiums up. And so you want to be able to understand how the management teams have performed, how they have thought through, and what sort of businesses they've gotten into or exited out of, and things like that. So, again, like in most businesses, most sectors, a handful of operators stand out. Buffett, PREM WATSA, the team at White Mountains, American Financial Group, and a few
Markel, maybe you want to say in that
Markel.
same, yeah.
Yeah, Markel. Even though Markel has had a couple of hiccups recently, but fabulous team. So you can focus on that, or again, depending upon what your investment style is, because there are always trouble spots. Maybe you can identify the turnaround in certain companies, and maybe you can partake in that. Be that as it may, I like to stick with the quality end of the spectrum, and I like to spend time with that type of a business model. Kinsale, particularly, as you rightly pointed out, is the only insurance company in the portfolio today. It is, it is on the property and casualty side of things. Property, casualty, and life, they're generally two big buckets within insurance. And within property casualty, there are a lot of subsegments. One of the areas within property casualty is called excess and surplus. Excess and surplus is essentially a business segment where certain hard-to-place risks are brought into, for different reasons. For example, in the US, you got a very, geographically speaking, a very hot, market in Florida. It gets hit from July through November. It gets hit with hurricanes almost every year. Depending upon the year, it can be very intense to a little light. And out in California, again, it's hot in that, every year there is a firestorm, either in the Northern California region or in the South. We just went through the LA fires in the South. Geographically speaking, these are relatively hot markets, and certain insurance companies, based on their difficult experience, may decide to exit those markets. And that doesn't mean the need for insurance has gone away. It's just that the standard underwriters, the State Farms of the world, the All States of the world, these are big insurance companies in the US. They're not participating in those markets. And so these risks have to be placed in some other non-standard market. In a standard market, as I mentioned, every state has a state regulator. And so if a State Farm wants to jack up the premium in, say, Florida, it needs to file and get the approval of the state regulator before they can take the rates up. Sometimes they give the approval, sometimes they don't. In the excess and surplus market, there is no requirement for form and filing. The companies can do what they want. And so it's a smaller market, about 120 some billion in total premium, as opposed to approximately total premium exchanged in the larger insurance world would be something like $1 trillion on an annual basis. So this is a much smaller market, but it's growing at a much faster pace. And that's where Kinsale operates. It's an excess and surplus. 100% of the business is excess and surplus. It's only in the US. They also focus on the smaller end of the spectrum. On a per policy basis, premium is only $15,000. The founder, Mike Kehoe, is the CEO. He owns more than 3%, just about 3+% of the company. And he used to run a different company called James River, which is also in excess and surplus. Some of his employees from James River have come over here. And I see the opportunity for climate reasons, for social reasons, a number of other reasons. I see the excess and surplus market continuing to grow at low double digits. And within that, actually, Berkshire is the largest E&S writer in the country. When they acquired Allegheny, it became the largest. Largest in the world on a global context would be Lloyd's of London. But yeah, Berkshire, AIG, Markel, Berkeley, all these are in the top 10. Kinsale, if you sort of start listing from the top, would be somewhere around 13, 14 in the world and barely mid-single digit market share.
And much more profitable than all of the above.
And that's where they sort of separate themselves from the rest of the crowd. I'm sure you know this, but perhaps your listeners, some of your listeners may want to spend some time thinking about the profitability metric of an insurance company. There are two major components: loss ratio, which is how much loss you incur on a per dollar premium, and the expense ratio, how much expense you incur as an insurance company to generate that $1 of premium. The combination, the sum of those two, is called as combined ratio. So anything less than 100% combined ratio is profitable. Anything more than 100% is considered to be unprofitable, at least for that period. And one of the largest auto insurers, highly efficient operators in the country, is Progressive. And when they write new business, they think about combined ratio of about 96%, meaning loss ratio and expense ratio add up to about 96. So they're making a profit of 4 cents on every dollar of premium. At least that's the going in expectation.
Claim.
The more recent time period, they've done much better than that, but that's the going in expectation. Kinsale, on the other hand, writes combined ratio of high 70s, low 80%.
Wow.
So more than about 20 cents of profit. It's a relatively new company, founded only in 2010, but you still have about a 14-year history to reflect upon, and it's been profitable at that level consistently, and also growing at a healthy pace. So that's the business that I own within insurance in the US. It's a fabulous business. Kinsale, unfortunately, is not quite at the same level of some of these great investment-related insurance companies, like a Berkshire or a Fairfax or others. But they are growing. Just about 15% of the total investment portfolio is in equities, larger equities. They've got some in-house built large cap equity portfolio, and they also have some ETFs and stuff like that on the equity side. But management expects that portion of the equity portfolio will continue to grow over time. And yeah, it's it's well capitalized, highly profitable. They have some operating nuances within ENS. Again, their focus on the lower end of the spectrum makes them very unique. $15,000 premium per policy is very low for even Markel and many others to compete with. So insurance as a business is highly competitive. But within that, they've sort of carved a niche for themselves. That's what I like.
Very interesting.
Sure, you haven't
Well,
even taken a
Sri-
sip of water. We want to let you
Yeah,
breathe.
yeah, I
Maybe
think,
one, two questions
I've been
before we
drinking
let you
my
go.
coffee.
I think we need to start wrapping it up, although we can probably be able to listen to you speak for a few hours more, but it is very, very enlightening things that you are saying about all those topics. So I'll
Gilad,
thank you
maybe-
again.
Thank.
Yeah.
Do you allow me one last question for you, though? I want Shri, maybe just before you go, Shri, just
Yeah, of course.
why you're so skeptical on serial acquirers and in general, and you can use maybe or specifically talk if you like about KPG, a company we talked about previously on the podcast, and I think if correct me when Chris has talked about or owns a company, and Chris Mayer, your friend, and so if you could talk a little about that before we let you go.
Yeah, and I would correct you slightly on that point.
Please, yeah, please do.
On the point about serial acquirers. I've been more cautious when it comes to serial acquirers over time, only because there are many factors that come into play. You have to be able to price the acquisition appropriately. You have to integrate the business. I used to work for a bank in San Francisco where we acquired insurance agencies and banks. Particularly the insurance agency acquisitions never really went well. The cultures were different, the compensation structures were different. So those types of things have always been a blemish in my mind that have sort of raised a red flag every time I've come across serial acquirers. And, you know, as Gilad started off this podcast with a famous quote from Buffett about acquiring or acquisitive companies, those have all been a sort of a reminder in the back of my mind. However, over time, I've come around to sort of at least appreciating why they do certain things and how they do it. As I said, I own HEICO, which is also in the same bucket. But if you take a step back and think about why this makes sense, it goes back to your question about what I expect in terms of return generation from businesses. Eventually, as a business creates intrinsic value, you know, how does it create intrinsic value, right? There are essentially two parts to that process. One is high incremental return on capital, which is the exercise that we sort of went through, most of it at least. That's one. And the second piece is the high reinvestment. So let me digress a little bit. If we start with, for example, if we start with a penny, which is 1 cent, in Israel, what is it called? Argonaut?
Agora is a penny, shekel is $1. So.
Right. So if we start with 1 penny, the same time yesterday, and doubled it every day. 1 penny yesterday, this time, it's 2 today, 4 tomorrow, 8. What do you think is the number on the 30th day?
We did it once, no?
Yeah, so about above 10 million.
Exactly. Yoav is absolutely right. So it's about 10.7 million on the 30th day. But what is it on the 29th day is a better punchline, right? It's half of it.
Yeah.
It kind of highlights a few things, right? It kind of highlights a few things. One, the power of compounding over time, right? As you kind of extend the timeline, the power of compounding takes the number meaningfully high. Second is it is also back-end heavy. You know, on the 29th day, it's half of it. And on the 30th day, it becomes 2x that number. But there are other assumptions that have gone in to this, which is you are reinvesting 100% of the money. You're taking a penny and reinvesting 100%. There is no transaction cost. There is no tax. You're reinvesting everything. But if you do that, that's the outcome, 10 plus 10.7 million, right? And that's where I think this power of reinvesting comes into play. This is something that Buffett has talked about. In fact, even in the most recent letter, he wrote about why he has not paid a dividend. Maybe he has paid a dividend only once. And he said, the board decided to do it when I took a bathroom break. And that's a very powerful part of the equation. Now, not many companies have that reinvestment opportunity. I talked about Copart. They go around acquiring land for their salvage yards. That's available for them. And so they reinvest in acquiring land. Outside of that, there is very little capital requirement. They have their own software and they develop it internally, and that's episodic. Or if you take Dino Polska, which is my Polish retailer, they reinvest 100% of the funds acquiring land and building up their stores. But not all companies have that opportunity. And so they have the companies have a few different options, essentially 5 different options. They can go repay the debt. They can make a special dividend. They can buy back their stock. They can reinvest. And that's where, or reinvest for their own balance sheet, or they can go make acquisitions.
Yeah.
That's where some of these serial acquirers take the lead and go make these acquisitions. Buffett and Berkshire itself is a sort of a serial acquirer in that regard. You've seen Markel develop its Markel Ventures. You've seen Fairfax do its own investments across the board. Many other non-insurance companies, Danaher,
KKR and Apollo doing some permanent capital investment.
You're right. So, there are a number of different types of businesses that kind of reinvest very extensively. And so that's where I have come around to appreciating the strength of that model. Where it can go astray is when you overpay, or when you have these cultural differences, or when you make acquisitions on an episodic basis. When you make a splashy, big acquisition, a different culture, different types of compensation schemes, that can go wrong in a big way. But when you have something like HEICO, which is making small acquisitions for cash constantly, 6 to 8 transactions a year, and particularly something like HEICO, they run a very decentralized operation. It's a company based out of Miami, close to Miami. And the acquired company, many times they don't even acquire 100%. They acquire 70%, they leave 30% for the selling shareholders to remain vested. And so they can...
A Jewish family, I believe, actually, right? A Jewish family. Yeah.
Mendelsohn is the last name. And actually, there is an interesting large shareholder in HEICO. His name is Dr. Wertheimer, W-E-R-T-H. He's been invested in HEICO since the early 90s. He was one of the early backers. A fabulous example of how long-term investing compounds wealth.
There was an article about him, I think, one of the papers I'll put in the show notes if I'm not mistaken, right? He's become
bought
very
Microsoft.
wealthy from a few Microsoft. Yeah, I read. I'll put it in the show notes.
Since IPO. But
Yeah.
anyway, you know, when you can make those types of acquisitions and integrate and allow them to run on a decentralized basis, there is significant opportunity to create value, to create wealth. And so I have come around to appreciating some of these models. And my friend Chris Mayer, he's my friend, philosopher, guide, misguide, whatever you want to call it. We talk on a regular basis. He was out in Stockholm. I couldn't go because of some personal commitments. There was a serial acquirer conference.
Red Eye Conference, yeah.
Red Eye Conference. And so he attended that and just came back. But anyway, he's been instrumental in helping me think through this. I've come around to appreciating a lot of these types of serial acquirers, but you want to be careful. You don't want to go berserk and just investing on all types of acquirers. There are different ways of doing this. You know, TransDigm, for example, is another competitor to HEICO, another serial acquirer, but they do it through leverage. It's a private equity kind of a model. Again, it's a fabulous company. You have to know who you are to be able to understand, appreciate the particular investment. If you don't know that, you know, as Adam Smith, not the original one, the Adam Smith that wrote the book, The Money Game, he said, the most important thing you need to know is yourself. If you don't, the market is an expensive place to find out.
Sure. We'll leave it with that. We'll let you go after so much. But you're more than welcome to come again and come here to Israel. As I said, we'll more have you. Gilad, I think the buildup was good. I think it was. We met the high expectations and exceeded them. Shri, again, thank you.
About that, thank you for having me.
Yoav, let us give recommendation to the end.
Yeah, sure. If Shri go, please, yeah.
Last episode.
Say that again.
Let's do today.
The recommendation with something we said at the end, you could, if you have something, a book, a movie, anything you want to recommend.
Book, a movie, a series, a trip, app, whatever.
Oh yeah, I mean, I love, I love hanging out in my office, and I love hanging out with people who are mostly all dead. It's the books about them, books that they have written. And I love reading, and that's part of how I spend my time. And so, in fact, one of the books I'm reading right now is Against the Odds by James Dyson.
I
He's
heard
alive.
that was a good one.
He's alive, but it's a fabulous book. There are a number of other books that I can recommend.
Dyson of the Dyson vacuum cleaner fame, correct?
Which one?
The Dyson is the guy the Dyson vacuum cleaner. That's him,
Yeah.
right?
James Dyson is the founder of the vacuum cleaner company and the vacuum cleaner itself. It's his autobiography, how he went through the exercise of, setting up his company. Other books that I would recommend. More recently, I've read, a book by Ward Farnsworth. It's about writing. It's about the classical English style. Another one I would recommend is Jeff Bezos' own letters.
Oh yeah.
Invent and Wander is the book that came out with his letters. But
here's the
Hebrew version.
Invent and Wander. Yeah, that's the one. Yeah. Fabulous book. You can see, in fact, see many of these features that we discussed today, high returns and reinvestment in that book. So anyway, we will end it there. I look forward to visiting you guys in Israel.
No, let's hear your recommendation. He's gonna give
mine is short. I want to let you go. Mine is watch a great series that's also in the States called The White Lotus. We're watching it now.
White Lotus, okay.
I'm a fan of The White Lotus.
Okay.
I'm going to give a recommendation. I gave it, I think, 2 years ago in our podcast when it was in Israel, but I had the opportunity to see this show in the States now that I'm here a few weeks ago. It's called Shen Yun. It's a beautiful, beautiful, I don't know how to describe it. It's a show that combines dance and an orchestra.
Oh, yeah.
The Chinese culture.
Right. I've seen that.
Traditional Chinese culture. It's simply amazing. I was
Yes.
there a few weeks ago, not so far away, and we went with all the kids, and it's simply spirit in lifting. It's so beautiful. The colors, the music, it's so beautiful that unfortunately, since the war, it hasn't been able to come back to Israel. But for those of you who are outside of Israel, in Europe or in Asia or in the States, it's still going, I think, for the next few months. So if you have a chance, you can go and watch it. It's simply amazing. I think that after the show, I slept like I never slept before. Simply happy. And for those of you in Israel who don't have the opportunity to see it this year, maybe next year, hopefully, there is a website that allows you to see all most of their dance and everything. It's not the same as to be in the theater, but it's so beautiful that I'd totally recommend it to everyone.
I'd watch for that. Yeah.
Yeah, great.
תודה רבה. Thank you all.
Thank you very much, and bye,
It's
guys.
been,
See you next week.
bye, Shvi. תודה.
Bye.
Thank you.
Thank you.